Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings in the fourth quarter and the full year of 2022, and that stock is 3M. And we can see that over the last year, this stock is underperforming the market. They're down around 25%, while the rest of the market is down only 7%, so they're not doing that good this year. But we're going to figure out if because of this recent downturn in the stock price, if this current share price is actually a good buying opportunity to buy into the stock from a value investing perspective. And so right here we can see some of the recent news that's come out surrounding 3M is that investors are a little bit worried about the company's top management, particularly with the performance of the CEO. And as we'll see in this article, they're going to point out a couple of reasons why that is. And so we can see right here, they sent a letter to Mr. Roman, the person who became the CEO of 3M in 2018, and they point out that the shareholder return for 3M has been negative 32% during that time period ever since Mr. Roman became CEO, compared to the overall 62% gain in the S&P 500. So they're a little bit concerned about his leadership because it's not really producing valuable returns for shareholders. And in particular right here, they point out that some of their forecasts for 3M's business are not looking that optimistic. They project that the company's sales in 2023 will fall between 6% to 2%, which is obviously not a good sign. Usually you want to forecast earnings growth and revenue growth, not earnings decline. And on top of that, they point out that 3M executives said that the company, on the company's January earnings call, that they're going to be cutting 2,500 manufacturing jobs globally, and their reasoning was that they were going to focus more on delivering value to customers and shareholders in a challenging economic environment with slowing growth from inflation and supply chain disruptions. And we've seen a lot of companies nowadays talking about the difficulties dealing with the recent inflationary and supply chain pressures. But seeing as 3M is now cutting 2,000 jobs globally, they're forecasting negative sales growth, and on top of that, they've historically, ever since Mr. Roman became CEO, produced negative returns for shareholders. It's really not looking that bright for 3M at the moment. And so right here we can see their income statement to see the underlying financial health for the business. We can see that compared to 2021, 3M's revenue has declined from $35 billion to $34.2 billion. So that's a decline of about 3% year over year. And we can also see that in terms of net income, their net income is down from $5.9 billion to $5.7 billion. Not only is revenue down, but earnings are also down. And then right here, we can see their balance sheet comparing 2021 to 2022. We can see total assets are down from $47 billion to $46.4 billion. And then total liabilities make up the majority of their balance sheet compared to total equity. They have $31.6 billion worth of total liabilities in 2022 and $14.7 billion worth of total equity. So considering the fact that their total equity line item has decreased, you would imagine that everything here has decreased, but in actuality, retained earnings has actually increased from $45.8 billion to $47.9 billion. And on top of that, treasury stock has increased from $30 billion to $33.2 billion. So they are not only adding earnings to their balance sheet, retained earnings, but they're also repurchasing shares of common stock, which is increasing their treasury stock account, which is obviously in the long run, if they continue to repurchase shares, it's going to boost the share price for their common stock. And lastly, right here, we can see their cash flow statement comparing 2020 to 2022. Operating cash flow for 2022 was $5.5 billion, down from $7.4 billion in 2021, and then further down from $8.1 billion in 2020. So this decline in cash flow from operations from 2021 to 2022 amounts to around 25% decline from $7.4 billion to $5.5 billion. And then lastly, in financing activities, we can see they've actually returned a pretty substantial amount of value back to shareholders through share repurchases and through dividends. They paid out around $3.3 billion worth of dividends and also repurchased around $1.4 billion worth of treasury stock. So they are returning a good amount of value back to shareholders through dividends and common stock repurchases. But overall, as we saw from their income statement, business is not really booming or doing that good for 3M at the moment. And so right here, we can see this discounted cash flow model to figure out the intrinsic value per share for 3M. Yahoo Finance, I think justifyingly so, given the fact that over the last 3 years, their business hasn't really grown, and they're projecting from their earnings calls negative sales growth. Yahoo Finance is estimating that they're going to grow at negative 0.23% for the next 5 years. So for the next 5 years after that, I pretty much just kept that consistent. The free cash flow they had for the most recent full year came out to be about 3.8 billion. They had a net debt position of 12.9 billion and shares outstanding amounting to around 550 million shares. And so that puts their intrinsic value per share at $45 per share at the moment, which means that at the moment they're trading above intrinsic value because they have a share price of $107 per share. So even though their stock price is down 25% over the last year, judging by the fact that they have projected negative revenue and earnings growth and negative cash flow growth, obviously, because of that, their intrinsic value per share is still trading or still below their current trading price. And so on the right-hand side here, I compare them to some of their competitors in the industry, General Electric and Danaher. These are also multi-conglomerate companies. And we can see that in comparison, gross profit margin, 3M comes in second place. Danaher comes in first place with a 60% gross profit margin. And also in net profit margin, 3M comes in second place with Danaher. Return on assets, 3M is beating out both of their competitors. They're also trading at the best price to earnings ratio relative to their competitors. GE's is way above in the clouds at 157 times earnings, and Danaher is around 26 times earnings at the moment. And then lastly, 3M pays the highest dividend, as we saw from their cash flow statement. They do pay a lot of cash to shareholders in the way of dividends. They had a dividend per share in their most recent full year of around $5.96 per share, which is definitely beating out their other two competitors. Danaher comes in second place at $1 per share. So from a competitor analysis perspective, if you're judging them based on return on assets, PE ratio, and dividends per share, it looks like it belongs to 3M. But in terms of profit margins, it looks like Danaher would take the first place spot for their industry analysis. And lastly, to end off the video, I wanted to compare them to some of the other companies we've looked at in prior videos. If you watched the last video or the last videos before this one, you can see that I've changed up the conditional formatting a little bit for these tables to make it a little bit easier to visualize here. So I added the coloring so you can actually see the difference in the percentages here. And we can see that in terms of share price to intrinsic value, 3M did make the list. They made the 9th spot here at 238% of intrinsic value. So basically, they're trading at 2.38 times intrinsic value per share because it's 45, and they're currently trading at $107 per share. General Electric and Albertsons are still the only two companies on our list to be trading below intrinsic value per share. And we can see in terms of growth rate that basically 3M didn't make the list. They are currently trading pretty low growth rate in the negatives here, negative 0.23. So they're not even beating out Johnson & Johnson's 3.89% here. And then if I scroll to the right here, we can see 3M did make the gross profitability list. They came in 6th place at 43.72% gross profitability, and then in 4th place for net profitability at 16.88% net profit margins. And then lastly, for stock performance, I changed the table up a little bit so you can see just how big the difference is between the performance over the last 5 years. We can see that 3M did not make the list because their stock performance over the last 5 years was negative 54%. So I think that's probably the worst performance over the last 5 years for the last 10 plus companies that we've looked at. So definitely not good. Not making the list. The only negative performance here is General Electric at negative 6%, and Microsoft is still taking the cake at 191% return over the last 5 years. So in terms of comparing them to the other companies we've looked at, they're not doing good in terms of stock performance. In terms of profitability margins, they're around middling of the pack. Adobe still holds the #1 spot for gross profitability and Microsoft for net profitability. And then in terms of growth rate, they have a negative growth rate, so they didn't make the list here. And then in terms of intrinsic value, they came in 9th place, not really doing that good, trading at more than 2 times their intrinsic value per share at the moment. In terms of industry analysis, I would say they come in around 1st or 2nd place, depending on what you prefer. If you prefer return on assets, PE ratio, and dividends, it's 1st. If you prefer profit margins, it belongs to Danaher. And then lastly, in terms of intrinsic value estimate, Not looking that good because of the recent change in management in 2018. A lot of their business has been experiencing a downturn, and so they are projected to grow at negative growth rates here, and that is not doing really any good for their estimated intrinsic value per share. So in terms of what I think of 3M overall, based on what we've seen from the recent news, financial statements, and also in the intrinsic value analysis, it looks like they're not really doing that good right now. But that being said, I mean, when the chips are down, it might be a good idea to keep your eye on stocks that are not doing that good, because you want to buy low and sell high. So I'm not too sure what to make of 3M. Let me know in the comment section down below what you guys think of this company. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.